Hey, good morning, everyone. Marty Missouri here, June 13th, 2021, with your weekly macro update. Going to keep this one short and sweet. We'll talk about the index for a second, take you through some of the key inputs this week. Some moved the needle, some didn't. Talk about the dollar again, do a quick technical look at the S&P 500, and ramble on a little bit about the Fed meeting coming up and inflation expectations and so on. In front of you is our index. For the week, we had a nice move up. It was up 5 points to 44 points. Let's see. Yeah, 44.9, up 5.42 points. So yeah, definitely this economy is coming out of the COVID crackdown and growing nicely, getting a ton of fiscal and monetary support. So that'll be interesting to see what happens, and that's the markets waiting for next week's Fed meeting with bated breath. Having been in the market for now 37 years, officially this August, I hesitate to sound certain about much, right? You get humbled after all those years. But I am certain that the Fed will not be raising interest rates and will not be announcing a cutback in its purchases of bonds every month, its quantitative easing program. You may get a hint toward inflation concerns among some of the more hawkish members. Jerome Powell has no interest whatsoever in spooking markets this week, I can tell you. Stocks went down nearly 20% in the fourth quarter 2018 when he was very adamant about letting the balance sheet roll off or essentially not reinvest principal payments as they came back, and then raising the Fed funds rate and so forth. He's done a 180. He's as dovish as any Fed governor in history, in my view, and he is intimidated to no end by the financial markets. So that sets us up for a situation, and this is what I've been preaching about, of inflationary pressure to the upside on a longer term basis, which is quite the debate. I chuckle a little bit because there are just some hardcore, deeply committed, really good economists who I have a lot of respect for, who I read all their stuff, are just so committed to the fact that this is just huge demand. Of course, that pushes up prices, but like I commented, I don't know if you read it or not, but to a Schwab chief strategist when he said, look, it's transitory, because he was showing ports beginning to open up, all I said was, well, of course, the transitory inflation is transitory. Longer term, we've got to do a deeper dive at more structural issues to get to the prospects for structural inflation. And for the first time in maybe my career, having done that deep dive and continue to do it every day, I'm seeing real risk of structural longer term inflation higher than we've seen. I've also said to you here on the videos and probably here and there on the written blog that, of course, the deflation camp is going to call victory when the bottlenecks start opening up, because things are going to come back. I'll show you a little bit of that here now. But that's not what we're talking about. That's to be anticipated. I expect inflation expectations to roll over. I expect commodities to give back some in the short term. We're talking about longer term, the bullet points. I won't go through them. I've done them several times already, probably do them some more. But the bullet points I've been sharing on the blog about why there's risk anyway. I'm not saying it's certain. There's no certainties in markets. But my goodness, there is substantial risk that inflation is going to run hotter. And we have a Fed who has no interest whatsoever in cooling that down because of what it'll do to the most massive debt bubble in history, and consequently to the equity markets and other asset markets. They don't want to be responsible for crashing the markets, and they'll get the blame if they tighten conditions right here. Now, having said all that, other central banks in the world are saying, hey, we have inflation, we need to do something about it. And so there is pressure, there's global pressure, maybe some political pressure on the Fed to tighten policy. I think if they do, they might get an obligatory, we're going to cut our bond purchases here next year, early next year, something like that. They won't say it this week. or even threaten to raise interest rates. If you hear it from Jerome Powell, I think you're going to see the markets crack, and to no small degree, frankly. And then, of course, they're going to back away from that just like he did in 2018, and they will turn those spigots back on wide open. So I do expect volatility. I do expect our core portfolio to experience a bit more volatility than it has of late. Although with the exception of last week, we didn't, but the past several weeks, we've been beating the stock market nicely, but we're not a stock market portfolio. Just over half of our money is in the stock market. Of course, everybody benchmarks against the S&P 500. Well, now more than half of our stocks aren't even in the US. So we have a very macro-centric portfolio. It's not just equity driven, and you don't want it to be, frankly, in this environment. We do want to be in the material stocks, of course, with infrastructure coming, and industrial stocks and solar stocks and lithium miners and rare earth and uranium miners. Of course, we want to do that in the US. But we also want to own foreign assets that have been gross underperformers for more than a decade now. Better valuations, better dividends that do really well in a weak dollar environment, which is paramount to the Fed's success. So again, folks, we'll have flat periods, we'll have down periods, we'll outperform, we'll underperform. I'm not really that interested in all that. I'm more interested in having a smart, well thought out, from a risk reward standpoint, macro driven portfolio. And yes, we're going to continue to spend a little money on insurance, and that would be those put options, just to protect us against something of a waterfall nature, like we had last year for 3 weeks, and the 60% drubbing in '08 and the 50% drubbing, or 85% drubbing if you prefer, in the NASDAQ from the tech bubble burst and so forth. So moving on. Weekly jobless claims, the expectation was 370. We got 376, but they were down like 9,000 from the previous week. That was good. Continuing claims came down by 258,000 from the previous week, so that was good, but that was after rising 146 the week before. Job openings in the U.S. virtually off the chart, all-time record 9.3 million, so lots of places for folks to go to work if they are so inclined. A sensitive topic for a lot of people. You could argue that, it's COVID. People are afraid to go back to work for COVID. Schools aren't completely open. Folks have to stay home for the kids. And I think that's to some degree, but I think it's obvious that it's all about exceedingly generous unemployment benefits. Those get cut back, expire, what have you. And I think we're going to see some really big jobs numbers show up in the weekly claims going down, and in the continuing claims going down, and in the monthly jobs numbers going up substantially in the months to come. Just one more on jobs, small business hiring plans that move the needle higher. This is in our index. So again, small businesses are open for business, and they need people, and they can't find them, which is their chief complaint in that survey this last month. Cash freight index popped nicely. Some base effects, coming off of what we came off of, but there still was a lot of delivery going on during the shutdown, as you know. Interesting to see prices come down just a bit. We're still super high in terms of delivery prices, very inflationary, but that's coming down. And of course, that's feeding the anti-inflation folks, or the anti-structural inflation folks, seeing delivery costs begin to come down a bit. But shipments are going up. And again, that's just another sign that the economy is in decent shape right now, for sure. Another sign of that is the economic surprise index. This has had a nice pop higher. This is what's actually showing up in the data versus what economists had previously expected. They miss the mark often. Well, now they're missing it on the upside. So the economy is exceeding their expectations, and we're of course going to score that bullishly in our index. CPI came out last week, 5% year over year. Of course, we're coming off of some real easy base effects. Inflation compensation, or market-based expectations, as people like to see. Here we feature the 2-year, 5-year, and 10-year inflation expectations. What this is the difference between Treasury inflation-protected bonds or securities and the nominal Treasury bond. The difference is the expectation for inflation as the TIPS, Treasury inflation protecteds, get stepped up for the rate of CPI. So again, still in excess of 2%, but this is exactly what we were talking about. This is expectations coming down as the bottlenecks begin to lighten up. And another quick look at our Bloomberg Commodity Index. This is that one that's showing those very classic technical flag patterns. We don't have quite this monster parabolic move breaking out of this flag, but we're actually still there. So technically it says commodities are going higher. I'm pretty neutral on commodities in the short run. Next week's Fed meeting could be impactful for commodities as well as equities and bonds and everything else, of course. So it's going to be interesting to watch. Probably pretty low volume Monday and Tuesday until we get to the announcement on Wednesday in terms of what they're thinking and their policy rate announcement and so forth. Copper staying right in that flag pattern. In fact, we look like we might break down to the downside, which would not surprise me as I've been reporting to you. But we had a nice boost on Friday, so we'll see if we break out of that. Then you're going to have a price target up here. We'll see. We'll see if this isn't enough consolidation and correcting of these big parabolic moves. Chinese data coming out this week. There's a bit of it. Their industrial production numbers, their retail sales numbers, and so forth. But the industrial production is probably going to be telling on copper. Part of the issue here, frankly, too, is that China's been trying to really tamp down on price. I mean, they've been threatening to do a number on metals prices to the extent that they can control it, which they can't entirely on a global basis. But they can certainly get the market excited, and they can certainly get traders trading futures and moving that price based on their comments or rhetoric or whatever you want to call it. But if we're right about the pressures, and you're talking about massive infrastructure and huge green energy investing, which needs a ton of copper. Copper's in a nice position here long term from a fundamental basis. There's virtually no doubt about it. Okay, the dollar, which I think is, if you had to pick one, this is the most important variable for markets going forward. Remember I said in here that it's looking bullish. Our technical indicators, which work beautifully for trading currencies, were telling us to be bullish. Rarely do I work against the technicals. I am here on a longer term basis. So what I said right here is that 50-day moving average is probably going to be resistance. Boom, it was, and we came off of it hard. But Friday, literally, we closed 3 basis points below the 50-day moving average, 0.03%. And then I said, if we break through there, I'm going to be looking to sell this resistance if I were trading it. That's a dangerous place. A lot of people are bullish on the dollar. If the Fed somehow hints that they may do something to squeeze monetary policy a bit, make it a little tighter, that's going to send interest rates up, and it could send the dollar up. It's going to be hell on the stock market, I think, if that announcement comes. So I think one of the most important correlations to keep our eyes on today is the dollar. If you're interested in stocks, the dollar and the stock market, and of course the dollar, the classic negative correlation between the dollar and commodities too. But the dollar is going to be key. In fact, you could just model the dollar against the stock market and probably do quite well on a long-term basis. So that's why I said last week, if indeed the folks who are bullish the dollar are right, that's going to be really, really tough on the asset markets. The powers that be know that. It's going to be tough on the foreign currency markets, especially where they have a huge amount of dollar-denominated debt. So, yeah, I could keep rambling, but boy, the risk of a higher dollar, or the risk to the markets of a higher dollar, is massive. And therefore, we look for the Fed to be uber careful in anything they say and do right now. And then lastly, and I will let you go, our chart that we've been looking at for years and years and years on the S&P 500. Let me come back to this one. So you've got those classic bearish divergences in the moving average convergence divergence in the RSI, these momentum indicators. You have a buy signal here that's kind of getting weak, so I changed my circle to yellow there. You've got your bearish upward sloping or rising wedge that the S&P has fallen below, as you can see here, and kind of fighting with that trend line. Still keeping above the 50-day moving average. That seems to be really good support. You see that hitting that there. This chart says eventually this market's going to roll over and it's going to give us a correction. That correction could be 5%, could be 15%. I've seen 50%, right? So that would be, of course, your bear market. And they always start from patterns like this, even last year, right? There's your rising wedge, and there's your divergences, and there's your 35% drop in 3 weeks, right? There's your rising wedge. there's your divergences, there's a correction, so on and so forth. The longer the wedge, the longer the divergences, the more dangerous this is. I think you need to break that 50-day moving average and come down in a big way. I'm not saying that's going to happen. I could probably just move my line here, probably will, right, and work off of this here. Going forward for a while. But, again, other than the technicals, which I really just score as a 0, you probably want to own stocks here, but I would hedge and I would be diversified in a big way. And then our volume measurement here, which I like this a lot. It's not, it's not a timing indicator or anything else, but it does speak to the strength in the market for sure. We are getting low here on the 10-day moving average of the daily volume. And again, so we broke down through that wedge. I circle this where it gets really risky, and it's not perfect. Like I keep saying, you could lose a lot of money shorting the market just on this one. But here we had low volume, and for an extended period of time, little spike there, and then kaboom, right? Low volume, correction, low volume, correction, low volume, choppiness, sideways action, low volume, little bit of a sell-off, low volume, tiny bit of a sell-off, but what do we have? Sideways action. So I'm starting to paint a rectangle like I did back here. Got your divergences, just stuff to realize, just to understand that the trading is not all that exciting, not all that compelling. You hear last week we kept hitting these new all-time highs, and that's all you see in the news. Under the surface, there's a lot going on, and lots to pay attention to and parse and study and crunch and so forth. We're really looking into our models and really back testing things and making sure we're looking at it from all the appropriate angles. And it's, again, this is a tough season. The summers are when things get tough. I expect we'll see some real volatility before the summer's out. But unless we see the Fed start to really threaten to tighten and the dollar go up and these sorts of things, we're feeling pretty sanguine about stuff, but we know risk can happen really fast. And you see the VIX go through the roof, and you see our options begin to perform, our hedges and so forth. We just want to be in that position to not be caught blindsided. So rather than going for grand slams right here and saying, hey, our model is very bullish, let's go for it. No, definitely be in a position to make money, compound at a reasonable rate, and try like the dickens to mitigate, because that's the best you can do, is mitigate the big downside risk when it comes. And that's just the nature of markets. If we can actually eliminate the downside, we'll eliminate the upside as well. So you do want to see bear markets and corrections come, believe me. I'll leave it there. Thank you, folks, as always, for watching and listening. Talk to you again soon. Bye-bye.